Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Monday, April 27, 2015. Inside the numbers tonight, we're going to take a quick look at a successful trade we just took off today, Rackspace. We're going to look at the E-mini and the SPY contract. We'll do crude oil. We'll talk about gold, big day in the gold market, interest rates in the bond market, and then we'll talk about the Dixie, which is the US dollar. All right, let's get into it. So first up, I want to show you Rackspace, and the reason why I want to show you this is because A, it was a successful trade, B, I want to show you why it was a successful trade, and C, I want to show you that I can find more of these trades. So here we are. We got into Rackspace between 53 and 53 and a half, depending on where the entry was for different members, right? So we're in this area here. And the reason why I entered the trade, because I had a feeling it was going to pop right up here, and today we took it off right over $56. And what was the high today? The high was $56.20. And what happened at $56.10, 56 something? I sent out an email alert to the members saying, hey, target was hit 56 on Rackspace. It was a nice 5% gainer in about a week. Therefore, protect profits, take half off, do something, but don't let this good trade turn into a bad one. So market did roll over a little bit today. Rackspace came in with it. And so what we had here is on the daily chart, okay, I was looking at a specific pattern, okay, and it really started over here. Okay, so my initial indication was that as long as the market, see this green candle here, and the low was 52.96. So I was in the camp of as long as the market didn't close on a daily basis below 52.96, okay, 51.34, sorry, the low, 51.34, then we were going to be in a bullish position, okay? Now, we're above the moving averages until this day came in, we were above the moving averages, okay? But what happened was, now let me show you what happened here. See this day here? In the middle of that day, okay, once the market started closing above this red candle, which we already came down and tested close enough to this low here, that told me it was a successful test. And if we didn't breach this number here, then we were going to move higher. So let's go over to the hourly chart and see what happened, okay? So where's that level? That level is here. Okay, we came in, we tested it. I consider that a pretty valid test. And then we popped up, we popped over it, and we took off to the races. So we were buying the market in here, okay, at 53, 53 and a half, okay? And then we waited, and then the market popped because we stayed above this level, and to me, we were above the moving averages. Look, let's even zoom out on a weekly basis. You're above the moving averages. Okay, these are strong moving averages in an uptrend, above the 50, 20, and 200 period moving average. Go back to the daily chart. Okay, we're in an uptrend, above the moving averages. Okay, there's nothing wrong with this chart. I mean, once this market comes down, you're going to want to come all the way down to $39.50. Okay, but we're far away from that, and we're not even that far from the 20-period moving average. So the 20-period moving average is starting to slope up, so that tells me it's a strong market. Okay, you go into the micro level, and on the hourly basis, I knew once we closed above this level here, okay, then we were going to take off to the upside. And from 53 and change up to 56, that's a nice, 4.5 to 5% gainer in just about 4 trading sessions. So just wanted to point that out to folks. It was a good trade. Trade's over. We'll find another one, and we'll move on from there. There's always another trade around the corner. Let's go over to the SPY contract. And what we've got here, I'm going to go to the daily chart first. And what we've got here is a market that went up initially today and then put in what we call a reversal day. Okay, we rolled over today. And what happened was, in fact, let me just swap over to the E-mini contract for a second because I want to show some numbers. And as you know, this is where I do the majority of my calculations from. So we went up today, and remember, for the last several days, last week, I was telling you 21.15, 21.13, 21.14, 21.15, and then I said the next target up from that was really 21.23, 24.25. Okay, so it was coming in around 10% increment, 10-point increments. And what happened today Well, we got that first level, obviously, 21.15. Then we started to really get strong here, strong market firming up, and we started to go higher, and we hit 21.19 and 3/4 on the high right here. 21.17.50. I'm sorry. 21.19.75. Yeah. 21.19.75 on the high. And then we just rolled over. So we came a few points short of what I would consider my target, and I now consider that an unresolved position. I consider that an unresolved target, missed target. So nevertheless, we rolled over, and the market was really weak all day long. Now, I find it interesting that we had a pretty horrific natural disaster over the weekend in Nepal, and the market topped out today, at least for the short term. Now, those turning points, when you see a big turning point, usually coinciding with a big political event, a geopolitical event, some kind of war event, which is considered political, some kind of a market jolting event, and a natural disaster isn't necessarily always tied to the stock market. However, it is necessarily an event that is caused by shifts in the earth, shifts in the planetary forces, shifts in the sun, shifts in the planetary alignments around the sun. And I know that sounds foreign to some, and I'm not going to get into that. I don't use that exclusively in my analysis, but I do take note of those things. And what I am taking note of is that we did have a shift, and those can normally signify some kind of cycle shift in the markets. Now, whether it's short or long term remains to be seen, and we have to see into tomorrow. So where do we go from here? Where do we go tomorrow? Okay, so right now in the E-mini contract, let me zoom out a little bit to the hourly picture. And basically, in fact, I have numbers. You know what? I'm going to give you the numbers on the downside. So I've got 2070 on the downside, but I have another number, which is basically 2085. It's going to be the 20-period moving average, 2085. So let's just put that in. It's important that that stays in here for a little while. So we're going to find some support at 2085, and then beyond that, it's probably back down to 2070. Now, 2085 is a little ways away from here. And if we have a weak open tomorrow, I would begin to look for 2085 as a target. What happens if we don't have a weak open tomorrow and we have a strong open tomorrow? Where do we go? Then we're going to look back towards the 2115, back towards the 2123, 24, 25 area, and then we'll reassess from there. Because the next number I have from there is another 10 points higher, which is 2135, that I have been telling you about since last November, December. So we'll see. The market was a little shaky today, but it could be a one-day wonder. I don't know. We don't know yet, but what I can tell you, and it becomes obvious when I go over to the SPY, and there's your numbers. I did put this line in already in the SPY. We're going to have support at 208.97, which is the coinciding number from what I just gave you in the E-mini contract at 2085. Okay, 208.97 is going to be support. But this is a reversal day, folks. This is an engulfing candle. It's a reversal day. Friday was considered a doji day. So this is really a bona fide reversal. It's not out of the question if we have another day or two of downside, and maybe even touch this 209 area, 208.97, and then maybe we can reassess from there and move higher. We'll have to see what tomorrow brings. Weak opening, I'm going to look towards 209. Strong opening, I'm going to begin to look towards 21.25. That's really the bookends of where we are right now. So we're kind of in the middle of that area, so it's a little bit haphazard from this point forward. But those are my bookends. Those are my support levels and my resistance levels, and we just take it one step at a time, let the market tell us what to do. And right now, today and Friday, the market is basically telling us what to do. It's telling us that it was putting in maybe a short-term top. Another indicator that I always like to use, and I haven't talked about in a couple of weeks, but was the IWM. And on Friday, the IWM was weak. And I thank you to one of the members for pointing that out on Friday. That was a good tell. It was a canary in the coal mine. The IWM was weak on Friday, began to roll over, and then it was weak long before the market rolled over today in earnest. And that was a tell. And that you can see here. I'll bring over the even the 10-minute chart. We can see the IWM roll over here at 10:10. And what time did the SPY roll over? About the same time, I guess. 10:10. Both rolled over at the same time, but it just seemed like the IWM was weaker throughout the day, and in turn, the IWM was down over 1% today, where the SPY or the SPX was down less than 0.5%. So if you do want to take the IWM as an indicator and say, is the IWM a tell or a canary in the coal mine? It was weaker than the broader market. That means that money was pulling out of riskier assets, okay? And when money pulls out of riskier assets, usually we have a weaker market ahead, right? If the market goes into less risky assets, which even is considered less risky as the Dow, and the Dow is down 0.25% today. So money didn't come out of the Dow, so that's usually a bad sign because money goes to the safe haven. Did money go into the bond market? Well, the bond market was weaker earlier, stronger later, so you can make a case for that the money did come somewhat into the bond market at some point during the day. And money came out of riskier assets. We'll see what happens tomorrow. We'll see if Apple can drive the market a little higher. I know a lot of folks are talking about Apple, but, you know, believe it or not, folks, it's the market that's going to take up the stocks. It's not one stock that's going to take up the market, although it does have an impact on the market. There's no question about it. It's a huge stock. It's a huge part of all the indexes. It's a huge part of everybody's portfolio. I get that. It's a big part of this market. But the broader market has to rally for there to be higher prices, and that's just the way it is. Let's go over to gold. What a great day in gold today. We just gold. Let's go over to the daily chart. Yeah, I'm sorry, folks. This is going to be a longer video tonight. I apologize. I'm just rambling on, but hopefully I'm giving you good information. So. If it's helpful and it can make you money, then who cares how long it is, right? So an extra couple of minutes not going to kill anybody. So gold rallied right out of the chute today, and then it just put in like a secondary rally in the morning here. Let's look at the 10-minute chart. We were up, and then we just shot up at like 10:20 in the morning. And guess what? By the way, that's around just 10 minutes later, but that's around the same time the market found real weakness. So is that a canary in the coal mine? So these are the things that you have to watch. These are the things you need to be cognizant of. It's not that these markets are always linked together, but for periods of time, they do play off each other, and they do give a tell from one to the other. So I think it's very important that gold just shot up out of the blue today. We have a Fed meeting this week. Does that have anything to do with it? What's the Fed going to say? Is the market trying to tell us something? Is the stock market getting weak to try to scare the Fed into prolonging the inevitable and raising interest rates? That's the dog or the tail wagging the dog. And is the gold market telling us that there's going to be continued money printing around the world, continued quantitative easing around the world, from Japan to China to the ECB, and then right back to America one more time? And if that's the case, then precious metals rally one more time, and that may be another canary in the coal mine. We'll see what happens, but we'll see how it unfolds. So where are numbers? Let's look at numbers. Forget about all that nonsense. Here are the numbers. What we have is we're going to have resistance at about 1212. If we don't bust through 1212 this week, we're probably going to find ourselves back down testing, 1185, even 1175 again before this market could stage another rally, because 1212 is going to be somewhat of a line in the sand. So if we start to close hourly and then of course daily above 1212, then forget the downside, then there's more upside to be had. But if we fail hourly and then daily at 1212, meaning we go up to 1210, 1211, 1210, 1211, 1212, and then all of a sudden the hour comes along and we close below that number on the hour, that's weakness. That means that I think lower prices are coming. So you wait for the next hour, see what happens. If you close above 1212, then that's bullish. Below 1212, that's bearish. So that's what's going to happen in terms of the price levels for gold. Let's move over to oil. Oil had started to put in a little bit of a rally today, and then it rolled over. But I put some stuff on the chart here because this is interesting. It's beginning to look more and more to me like it's going to break one way or the other. So what I did was I offered some support levels, and first level of support is going to be 55.76. And the reason I did that is because if anybody wants to be long oil, you can be long oil against these targets, okay? Riskier traders can be long oil against the second support, 54.88, give it a little more room, okay? And less risk type of trade, okay, would be to take a long here, and then your first level of support would be 55.76. And if that didn't hold on an hourly closing basis and then daily closing basis, then you might want to take that trade off. But I like this pattern. This pattern tells me unless we break below these support levels, specifically this one, it's really the line in the sand is 54.88. As long as this market continues sideways and stays above 54.88, then I think higher prices are coming. The longer we go sideways, the higher we're going to go as long as we stay above 54.88. That's the way I see it. So that's pretty simple. That's your line in the sand, 54.88 on the downside. And the upside, it's really going to be 58, then 60. And if we can break above 60, then we may get as high as, and this isn't all on the same move, this isn't all in 1 week, it's just a target number that came up in my calculations, 64, okay? So, we have a downside support level, 54.88 line in the sand. As long as we stay above it, if we begin to move higher, we start to look for 58, then we look for 60, and then from there, I'll be back at you with higher numbers, all the way up to 64, but that's not on one continuous move. Okay, where are we? All right, so we talked about gold, we talked about crude oil. Let's go over to the bond market. This is the TLT, and I took away that other stuff from before, and basically what I put in here is resistance at 129.55. I think that the bond market is in a downtrend right now. I think we have lower prices to be had. So the reason I say that is because if anybody wants to be short the bond market and short TLT, for example, which tracks the 20-plus year Treasury bond, okay, you can be short against a resistance point of 129.55. Hourly closes and then a daily close above 129.55 would be a stop out, but I would be expecting more downside, potentially all the way down, and I drew this line in, all the way down to 125.81. We'll just round it up and say 126. So if the bond market started to come down, okay, this would be my ultimate downside target, but I would have taken something off on a short before I got there because you'll probably come down and test this double bottom and find a little support here at, we'll call it 127.50, 127.70. So where we are now is I would be short the market and I would just be short against 129.55. Today we closed at 129.07. It's basically a 50-cent stop. I think your risk reward is pretty good there. So I think there's lower prices to come in bonds, which means higher prices in yields, which could mean a bunch of other things for a lot of other stuff, but we'll talk about it when we get there. Okay, so we did the bond market. What else do I have? The dollar. So the dollar's also weak, and guess what? We're coming closer to the buy zone, okay? I bought a small position in the dollar up here. That's okay. I told you long before I even bought it that if the dollar came into the buy zone, I would be all over it with three hands, okay? Where in the buy zone? I'll let you know when I get there. But if we have another couple of days of weakness in the dollar, I think we're going to get there. So if we have weakness in the dollar, it's not out of the question. It doesn't always work this way, but it works this way some of the time. If we have weakness in the dollar, okay, what might we see in the oil market? We may see a pop in oil right out of this yellow shaded circle or sphere. I found the sphere on the chart and I wanted to use it. It kind of looks cool. So anyway, that's something to keep an eye on. I think I gave you everything I had. I'm going to give you one more idea. I'm going to give you an idea in, where's my symbol here? Natural gas. And I just want to give you this idea because it's not so much that I think natural gas is extremely bullish. I don't. But it's an idea because I want to show you how to take a trade. And those that think catching a falling knife is impossible, I want to show you how to take a trade at the bottom of the chart by limiting your risk. Okay. So natural gas has been in a downtrend. There's nothing good here. There's no sign of a bottom. You have a little bit of a doji candle. This is today's data. Yeah, the doji candle today. That may or may not mean anything because you've had them before. But the point is, here's one. Here's one, so it doesn't mean much all the time. But if you wanted to be long natural gas, okay, what's the low of today? Okay, 248.1. Okay, $2.48.1. Okay, where are we now? 250, 250.5. Okay, so what happens is, if you wanted to be long a market, whether it's natural gas or any other chart that looks like this, you take the trade, you put your stop on an hour, you either have a mental stop on an hourly close below that daily low, which was 248, or you have a hard stop below 248, and look at the risk reward. If it goes down there and stops you out, so be it. You tried it. It's not the end of the world. It was a low risk reward. But let's say the market pops, okay, and we go higher from here. You've basically picked off the low. Now, I'm not suggesting this is going to hold, and I'm not suggesting that these always hold. I'm just suggesting that knowing where you're wrong is 2/3 of the battle. If I were to take a trade in natural gas right now, I know where I'm wrong. Okay, that's everything to me. I want a good risk-reward setup for the probabilities to be in my favor to make money. And that's the way the trading business works. The capital is our inventory. It's all we have. So what we have to do is manage our capital, manage our inventory, manage our trades accordingly, know where you're wrong, and accept the fact that sometimes we're going to be wrong. But when you take a trade, you're 100% right. You're 100% confident the trade's going to work out, but we know they don't always work out. Okay, we just have to recognize that. All right, that's enough babbling for tonight. Hopefully this is helpful. Hopefully, folks, you're able to take some of this information and do some good with it. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.